Hey everyone, welcome back to Corporate Decoder. Today we're diving into Broad Street Realty's annual 10K report, which, let's be honest, sounds about as thrilling as watching paint dry. But trust me, there's always a story hidden beneath those numbers. This year it's about a company navigating some tricky financial waters, so let's see if they can keep their heads above board. First off, Broad Street Realty is filing their annual report, which means they're giving everyone a look at how they did over the past year. This isn't just for show, it's required by the SEC, making sure companies are transparent with their investors. For the year that just ended, December 31, 2024, Broad Street owned 15 properties spread across 4 states. That includes almost 2 million square feet of space. They're leasing out the majority of that, with the total portfolio about 92% leased. It's important to note that not everything is rosy though. 2 of their properties are currently under redevelopment, meaning they're not bringing in their full potential revenue just yet. Now let's peek at the numbers. They have 1.649 million total rentable square feet in their portfolio. The annual report also says that on average they're charging about 15.21 FICE per foot for their retail spaces. Throughout the year, they've been actively managing their debt. Notably, they received a $19 million loan to pay off an older one. This kind of financial maneuvering can be good or bad. It means they're either getting better terms or just kicking the can down the road, hoping for better days. Now for a quick health check, the report says they have filed the report, which can be translated to they are following the rules. Of course, like any good corporate report, there's a section dedicated to forward-looking statements, which is really the company's way of saying, hey, here's what we hope will happen, but no guarantees. They are required to mention many potential risks with statements like these. Here's where things get interesting. They have a deal with Fortress Investment Group that gives Fortress significant control over major decisions. A trigger event could give Fortress even more power, including the right to take over managing certain properties. Shifting gears, here's a quick look at where some of the biggest rents comes from. Dollar Tree, Planet Fitness and Casa Bonita being on the top of that list. So if you're planning to buy stocks with Broad Street, keep in mind that these are the guys that are paying their bills. One thing worth noting is the lease expirations. A sizable chunk of their leases, nearly 9%, are up for renewal in 2025. So if they are in trouble, we will probably see the effects of that next year. That means Broad Street's team has to hustle to keep tenants happy and renew those leases or find new ones. The portfolio spans the Mid-Atlantic region and into Colorado. They have different key tenants for each of them, ranging from post offices, dollar stores, or auto zones. So if one industry tanks, at least they will have other sources of income. They're looking for high population areas with good visibility for their tenants, also making sure to have a good tenant mix, and that's the properties. We also have information about their top 20 tenants, but that's already listed, so moving on to the financial results of the company. Now, the big part of the show, financials of the company. They say here that the revenues decreased about 2% from the previous year because of 2 properties they sold in 2023. The good news is that operating expenses also decreased by about 14%, mostly because of the gains they don't have anymore because they don't own the properties. They also carry a significant amount of debt, about $348 million. Lots of times it could be from acquiring properties, so they need to make sure their investments pay off, or those debts could become very problematic. They have 3 loans that are maturing soon, so they will need to refinance it fast. Here comes a slightly concerning part, their arrangement with Fortress. This gives Fortress a lot of say in how Broad Street operates, potentially limiting their flexibility and creating conflicts of interest. If Broad Street makes bad decisions, the power that Fortress will have will be even more destructive for the common stockholders. Here's the harsh truth. Their stock isn't exactly flying off the shelves. There's very limited trading, which means it might be hard to sell shares if you need to. Finally, 2 guys, Jacoby and Yoki, control a big chunk of the company. It's generally not good when 2 people have so much power, so any investor should consider if their interests are aligned. Here's the really interesting thing about this report. The auditors, Cherry Bekaert, raised concerns around going concern, which mean that it's not going to be a fun year ahead for the business. Also, there's a lot of manual work being done in this company, not directly stated. Alright, so let's summarize all of this information. Broad Street Realty seems to be on shaky ground. Revenue is down and there's not much trade volume for their stocks. They also depend a lot of people from other people. So if they revoke a waiver, it can send this company to a total loss. However, if the management can turn things around, there might be some opportunities. Real estate, especially grocery anchored centers, remain essential. And as long as they can prove they are able to pay what they own, it's not the end yet. Thanks for watching Corporate Decoder. If you found this breakdown insightful, please give us a like, subscribe for more deep dives, and tell me what company I should investigate next in the comments below.